So what we intend to do is, I think we will have some a little differentiated discussion today, something on the lines of what I had presented at the annual conference. And what will happen is that we will get some more time to do question and answer. At that point of time, there was limited time for this. So I'm sure, given the format of this interaction, we can have a much more fruitful interaction as well. So what I will do is very quickly take you through the presentation, not more than 10 minutes, 15 minutes, and then we can have a time for questions and answers for that. So I'll be just sharing the screen. Yeah, I hope this is visible to all the participants.
Yes, sir, perfectly fine.
Great. So the topic which we are discussing is what is work for equities in India. So a lot of fund managers talk about various strategies, and I think that was also what we are trying to discuss, that what strategies are good, how are we managing portfolios, what is the likely sort of great strategy, etc. What we want to do at Union Mutual Fund is be very process focused. So what we wanted to understand is what has historically done well in India. A fund manager may think quality is good. Someone may think growth is good. We wanted to check from actual data. And then we wanted to adopt whatever is the best available strategy into our funds investment processes to ensure that we give a consistent outcome driven by a process. So that is the objective of this entire study. Here we have looked at 4 quantitative factors: growth, quality, value, and momentum. And this is the research methodology. We have used median as the measure of central tendency. We started looking at the data from 30th of June 2011 till date. Our data set comprises of almost 1700 companies. We have divided the entire data into 3 parts: banks, non-bank lending companies, and then finally the non-lending companies, which means manufacturing companies, FMCG companies, service companies, etc. So the third part is the biggest part. And then we created various portfolios based on factors to understand which portfolio does better compared to the other, and that will tell us which factor is better. So the way in which this entire study is constructed, it is divided into 2 parts. I'll take growth factor as an example and explain. The first part of the study deals with retrospective factors. Like this is retrospective growth study. What retrospective simply means, it just means that if a computer took all the data of these 1700 companies and then it just looked at which companies grew at a fast pace in terms of their profits, and then it took that company as part of the above average growth portfolio. Then the computer just divided the entire 1700 companies universe into 2 parts. Companies which have historically grown at faster pace compared to the other portfolio, which means companies which have historically grown at a slower pace. So there are 2 portfolios. Now what we are going to do is, for every rolling 3-year period, so let's say the computer looks at June 2000 or March 2011 data, previous 3 years, and sees what is the profit growth of companies and then creates this portfolios. Then we will look at the next 3-year data of this portfolio. What happened to the stock prices of companies in the above average growth portfolio, and what happens to the stock prices of companies in the below average growth portfolio. And that is how this entire study is. The universe median is what is the total return of all of these 1700 companies on a simple median basis. So it actually will not differentiate between a 10 lakh crore market cap company with a 200 crore market cap company. The idea is that we will remove the bias. When we do this, what we found out is that out of the 9 periods in which we created these portfolios and checked for returns, 7 times on a consistent basis, companies displaying a higher profit growth have done well, have delivered a superior return over the subsequent 3-year period. And this is a very important finding. Except for the last 2 years, all of the other 7 periods, high growth companies did better than low growth companies. Now, the second part of this study is, what if we are able to forecast the next 3-year returns? So let's say the analyst sitting in June 2011 is able to predict the profits of all of these companies for the next 3 years. And what he has to predict is only one thing, which is whether the company is going to grow faster than average or slower than average. He does not need to predict whether these companies are going to grow at whatever number right up to 2 decimal points. Just to see whether the growth is going to be above average or below average. When he is able to do this, we then check the returns of such a portfolio of above average growth companies and below average growth companies. And the results here are unbelievable. Every year, on a rolling 3-year basis, the faster growing companies delivered on an average 20% outperformance over slower growing companies. Not even a single period was missed. Clearly, market has rewarded growth significantly. And what matters to market is also future growth, which means prospective growth rather than historical growth. So this is how the studies have been performed. So we have discussed the growth part. Now the conclusion is future growth, as I said, is stronger, and its business growth is a very strong indicator. Then we look at quality factor. In quality, we look at return on core capital employed. And when we look at return means earnings before interest and taxes, excluding non-operating other income. So the core return on invested capital. Once again, the retrospective study for quality tells us that quality is important. 7 out of 9 times quality would have done well. However, if we are able to predict the future quality, it will give us much better results than prospective quality, which means if I'm able to forecast what is going to be the return on capital. Sometimes there may be a loss-making company, it's having operating leverage, and in the next 3 years it may be able to generate a high return on capital. Then that will be a far important criteria rather than what it has done in the past. Once again, confirming what we saw in the growth factor. Future quality is far more important than past, and quality is important. Third, we look at value factor. We look at companies' enterprise value, which means market cap plus debt, divided by their EBIT. And then we create 2 portfolios. Companies which have cheaper EV by EBIT and companies which are expensive EV by EBIT. Once again, historically, cheap has done better than expensive. But if you are able to predict profitability better and able to buy cheaper companies based on future profits, then 10 out of 10 times or 9 out of 9 times you would have done better than cheap would have done better than expensive. And finally, the fourth factor is momentum factor. Here we look at relative price strength. There have been a lot of studies which have been published that price momentum can produce stronger returns. So we wanted to check based on the current definitions of momentum. What we saw is that 6 out of 9 times high momentum portfolio outperformed low momentum portfolio, but the results were not very, very strong. However, the study demonstrates that there is some momentum premium which exists in India. So this is the summary. On an average, if one were to look at just the historical data, growth would have delivered the best return on a prospective basis, whereas value would have delivered the best return on retrospective basis. However, all the three criterion delivered a stronger return on a prospective basis. So from our perspective, what we concluded is that forecasting and understanding future growth and quality is very important, and creating portfolios based on that is very crucial. That is the ability to do much better. And a quantamental approach, which is quantitative plus fundamental approach, can deliver superior returns. So I think that was the outcome of the entire study. So with that, we wrap up one big component of this discussion, which is what has worked for equities in India based on the 4 factors. We also wanted to talk about what has worked in valuation. So generally people talk about PE multiple, but there are other multiples like price to book also. What we want to highlight is that, let's say you want to look at what is the fair value of companies. It is simply a multiple to the value driver, and this value driver could be core earnings or core book value. This multiple is based on actually 4 factors, and it is very much ingrained and coming out from theory. These 4 factors are: what is the sustainable return on equity, what is the sustainable growth, what is the risk-free rate, and the riskiness of cash flows. All of these 4 factors drive the multiple. That is why some companies may be having 50 multiple, some companies have just 5 multiple. Looking at multiples, you may not be able to judge whether it is cheap or expensive. Now, what we have done is we have tried to compute the fair value of Nifty and then look at how this fair value is moved versus our GDP. What we discovered is that there is a very strong relation between fair value growth and nominal GDP growth. If GDP goes up, grows faster, fair values also grow faster, and vice versa. And this is a very important chart. Once again, here what it highlights is what has worked for valuations in India. So various people have talked about Nifty PE multiple, and we generally tend to look at that number to judge market valuation. Based on this data, it is futile to compute market valuations purely based on PE multiple. We have written a full white paper on discussing why this can be misleading. And this chart clearly tells you that market oscillates around the fair value and not around the EPS, which is an arithmetical policy. I'll just quickly take some examples. So this gives you 2 examples of companies from FMCG sector. One is a foods company, second is a cigarette company. So while these two companies are in the same sector, you would notice the fair multiple of one is much higher than the other. And the big difference between both these companies is the underlying earnings growth. So the earnings growth for the foods company is far higher than that of the cigarette company for obvious reasons. And that is driving the very high multiples which the foods companies can enjoy versus cigarette company. Of course, the ROE is also higher, but the big delta comes from the growth. In summary, high PE may not be expensive and low PE companies may not be cheap. What you need to judge whether a company is cheap or expensive is what is the sustainable earnings growth and a sustainable return on equity? What is the underlying riskiness of the business? And what is the price I'm paying to this fair value? We need to be aware of value traps. The big difference between a cheap company and a value trap is that in a cheap company, fair value is growing. In a bargain, the fair value is falling. And that is a very, very big difference. In terms of index EPS, we should be very, very careful. Index EPS growth or decline does not indicate corporate growth, profits growth or decline. It is a big, big fallacy. You will have very, very different results and results which may not be accurate if you follow this. Also, I think there is a myth that if a P multiple of a company is high, it means it's a growth stock and vice versa. That may not be the case. P multiples may be high because the returns on equity is high and the business riskiness is very, very low, but not necessarily the growth is high. So that is one of the other myths. And last, but the most important point to remember is that equity is a high duration asset. And equity valuations will have significant inverse relation with interest rates. So if interest rates go up, the multiples will fall. And if interest rates fall, the multiples will go up. I think that was what I wanted to discuss. I think that's we can now open the floor for questions. Varunji, I'm sure if participants have any questions, I'm happy to answer.
Absolutely right, sir. Growth, opportunity, value, and momentum. पार्टिसिपेंट्स अगर कुछ पूछना चाहते हैं तो वो अपना माइक अनम्यूट करके क्वेश्चन कर सकते हैं.
Hello, I'm Deepak here. Can I ask a question, please?
Sure, please.
Yes. Please go ahead.
Sir, I wanted to ask you now, as the values have caught up, if you notice, all the value funds are doing better than the growth. In fact, after a long, long time, they've caught up, especially like HDFCs and Discovery and ICICI. Sorry to name them, but do you think that they will fall aside and then again the growth will catch up? And we should rather move from these growth factors to the momentum and from value factor to growth factor?
I think you have raised a very important point, Deepakji, and this is at the heart of the discussions which we had. One of the most important points which we discussed is that equity is a long duration asset. But within equity, if a company is a high growth company, it will have a much higher duration compared to a value or cheaper company. This is because the cash flows which an investor will get in a growth company are far into the future compared to a cheaper company. And hence, the biggest impact of interest rate increase on equity will first happen on growth companies, and then on bargains. So your observation is right. Value has done better. But over a period of time, I think the underlying fair value growth will catch up. So if you take a 3-year, 5-year view, and if the underlying company's growth is reasonably strong, the valuations have already compressed for the growth basket, and then it will start showing up in the form of better returns. So yes, this value versus growth will keep oscillating, and I think the current outperformance of value versus growth is largely to do with interest rate increases.
Okay, further on this particular question, I just would like to clarify from your point that you would not be investing in any of these metal stocks, mining stocks, or things like that, and still you would go for consumer discretionary and things like IT and other sectors which are growth oriented. Would that be?
So when we want to invest in companies, we want to invest in companies which we think are first good businesses run by good management. Then we look at valuations. So when we do that, most of these metal companies or commodity companies do not cross the threshold of good company because the potential returns are not predictable. There is very high level of riskiness in the business. Hence, we have a very limited, very small exposure to most of these commodities. In fact, our exposure is significantly lower than our peer group average. On the other hand, we have exposures to largely companies which have some competitive advantage where the returns on equity are high and they're sustainable and they can have some meaningful growth going forward. So that is what these are the type of companies which we will invest in, and we'll create a diversified basket of companies, not concentrate in few names.
Thank you very much. You have answered a few questions of mine and gives me a direction as to what I should do in the future. Thank you so much.
Thank you, Deepakji. Thank you.
More questions, please. Okay, sir, most of the people, investor or advisors, are looking for the growth and value, but what is the part of opportunity? Actually, sometimes we mix opportunity and momentum. Both are looking same. So how you define both separate?
Yeah, see, I think investing has become very complicated because of a lot of these jargons which are used around. What we generally have highlighted and we have communicated is that over a 5-year, 10-year period, growth at a reasonable price is the best strategy. The problem is that most people have a very different opinion on what is reasonable price. We have internally defined very straightforward approaches in that criteria of reasonable price. We look at what is the fair value of the company today and over a 5-year period, and then we look at what is the price we are paying today and what is the potential return we are getting over a 5-year period. And we do this for all the 160 to 200 companies which are there in our universe. And then we look at the potential returns. Companies which are expensive, the potential return will be lower, and hence our exposures will also be lower, and vice versa. So we have a very, I would say, balanced approach in terms of looking at growth at a reasonable price. And hence, we don't think so value per se is very different. We are actually also value investors, but I don't think so anyone would deliberately want to invest in poor companies which are, going to die in the next few years just because they are cheap. So, and no one wants to overpay also, right? So I think the way to look at it is you need to have a disciplined approach for buying growing companies and a system which can tell you what is a reasonable price. Growth at any price is absolutely not what we would want to look at. The problem is that most people just tend to look at P multiple and judge whether this company is cheap or expensive. Someone would say that, hey, the 50 PE multiple, and you are saying that you won't buy growth at any price. And we would come back and highlight and showcase what is the metric we are using. We are clearly using what is the fair value of the company over the next 5 years and what is the price we are paying. Compare that to the average returns of the entire universe and then construct portfolios using this metric. The pretty scientific approach, along with discipline, will help in generating sustainable and process-driven outcomes.
Thank you, sir. Next question. Sir, in your presentation, you quote that equity is the highest duration asset class. This is very true. But in present scenario, if someone has invested in growth for 10 years or 20 years and rebalance their portfolio, so you don't think realignment and rebalancing and these things are equally important at the part of advisors also?
Yeah, absolutely. I think, you see, equity, the nature of the asset class is high duration. And hence, it is the role of the advisor to create a balanced portfolio for clients. And hence, we have discussed the nature of the beast. The idea is that you, as an advisor, should know that when you are, for example, let's say hypothetically, when you're creating a fixed income portfolio for your clients, you would always look at duration, right? He has some liquid emergency fund requirements. So I'll recommend 10% of his portfolio to liquid fund, something for 2 years, something for 3 years, something like that, right? I don't think so. Most of the people look at equity in that fashion. And hence, it is very important to remember that equity is the highest duration asset. And you will allocate portfolios, portion of the portfolio to equity, knowing very well that this is a high duration asset. It will be volatile, but it will deliver a very strong return over a longer period of time. And that is what we wanted to communicate.
Hello, sir. ESD here.
Hello, sir.
I want to ask that you look at growth first, then value, then at quality.
So we look at growth and quality first, and then we create our universe of companies which are investable, and then we formulate the fair values of all of these companies, and then create portfolios of companies which are available at a reasonable valuation amongst this universe of growth and quality companies.
So growth and quality is the first metrics that you look at.
Yes, absolutely. So it doesn't. So our stock picking doesn't start with valuation, and that is what differentiates us. That you don't look at a company that it has fallen so much, so it is cheap. Let's look at it. It is the other way around. This company is a good quality company, and it's growing at a reasonably good pace from a long range point of view. Let's look at it. That doesn't mean that we'll buy it in our portfolios. We will buy when the price is good, probably.
Sir, may I ask one more question?
Yeah, please.
You see, generally we have an issue of holding companies available at a discount. For example, maybe Godrej's, Tata's,
Yeah.
or Bajaj's.
I'm aware. Okay.
And a lot of portfolio managers who prefer to hold the holding company rather than the companies directly, saying that we get it at a discount, so we get a growth of those companies mimicked I mean, you would have got my question as to what.
I understand.
So what is your view on it, and what is the view we should take? What is the stand which we should take, on this?
See, first and foremost, you should, as a portfolio manager, we also need to have a path of exit. So I buy a holding company which is, let's say, at a 50% discount. Do I have a reason to believe that this discount will go down to 20%, 30%? If the holding companies have perpetually traded at a discount of somewhere between 40 and 70, 80%, then it is unreasonable on my part to, bet on discount going down to 20%, 30%. The discount can widen also. Unless and until I have a clear catalyst, I think it can be a little bit riskier to own the holding companies. I'll give you one more example. Holding companies, still there is a problem of intermediation, meaning when will the promoter, will it dissolve the company and give you all the shares, underlying shares? It's a little, probably a little far off in terms of value unlocking. The starker situation is the gap between a ordinary share and DVR. DVRs are available at some 50-60% discount. Nowhere in the world they are available at more than 5% discount. But since 10 years, it is available at this 50% discount. So I may come and tell you that, I am holding them at a big discount. I want to but ultimately the returns from these DVRs or holding companies will mimic the underlying companies. So it is up to you to either own the underlying companies or own the holding companies if you are very confident, I think. But the central view is that you are taking a call on the underlying companies. So that's how I think we should look at it.
Thank you. I think you answered my question. Thank you.
So we have few more minutes. Anybody can unmute themselves and ask the question.
Mr. Paharia, what is your view on the international scenario? Any thoughts on that? Do you think that the US market may actually be going downhill, and hence it may not make sense for us to own those funds which will have US holding, US companies? What do you feel?
So, see, one thing is that the Indian market has already outperformed the other developed world markets by 20% on a year-to-date basis. So whether or not to hold US, its markets are difficult to comment purely from a valuation point of view, because we are not experts on what is going on in terms of valuation of individual companies. But if you, from a macro point of view, if one were to look at the outlook is very, very grim. And one of the big reasons for that is the same as which we have discussed during the presentation, that equity is a long duration asset class. And American stocks have seen the biggest benefit over the last 20-30 years from falling interest rates. In fact, 40 years. The interest rates in America were almost, I think, about 14 to 15% in 1980-82. They have consistently fallen to negative territory till about 1 year back. And from that point, they have risen very sharply from 0 to 4%. I think the impact of this is huge. We are yet to see any material impact of that on the economy, markets, etc. But I think the potential for the impact is significant, very high, and I think I would not hazard a very big guess on what is the potential impact on valuation of such a move. But suffice it to say, the situation is very, very difficult in developed world, much more than it is in India. India is a growing economy, and while valuations are a little bit on the higher side, they are not out of the world compared to a lot of other parts of the world where growth is slow, but valuations are rich. So I think that valuation correction can continue to happen. Even India is now trading at a little bit premium to its underlying fair value, and there could be some slowdown in growth, which can happen in the next 6 months to 1 year. Having said that, on a standalone basis, we still think that fair value growth will remain strong in healthy double digits over the next 5-year period. And even if there is some correction in valuation due to higher interest rates, the potential return for of investors staying in the funds for 5 years, in equities for 5 years, still going to remain strong.
Thank you. Thank you, Scott.
Sir, I have one more last question, maybe. I don't know whether I'm asking too many. You see, they say the return expected from equity is the inflation plus something else, If the inflation is higher, don't you think that we should be getting higher return even from this point of time?
Absolutely. I think you have hit the absolutely the right point. And I think all of you are distributing fixed income products. So before understanding equity, I would try to explain fixed income, and using that, maybe it will be easier for you to understand this. So let's assume you have a bond which has a 7% coupon, and it is trading at 100 rupees today. If the interest rates go up and your expected returns go up, what should happen to the bond price for this 100 rupees? Should it go up or down?
It'll go down.
It go down, right? So think about it. The EPS of the bond is the same, 7 rupees for every 100 rupees. For your return to go up, the bond price has to fall, which is why if inflation goes up, it is very natural for you as an investor to expect higher returns. And these higher returns will, of course, have to come by valuations dropping, which is why we have been talking about interest rates as a key headwind. So yeah, I think you're fair in terms of expectations, but at this point of time, there is a little bit richness in valuation, which is why the potential return is slightly below what you should be expecting from on an inflation adjusted basis. However, it still remains healthy on a relative basis compared to all other asset classes.
Thank you so much.
Sir, any sectoral analysis from your side? Which sector to be positive and which sector to go negative here?
So I think from our point of view, we are a positive consumer discretionary sector, which is largely automobile, auto ancillaries. We are positive telecom sector, We are
Mhm.
positive consumer staple sector. We are positive the industrial sectors. And we are negative sectors like IT.
Mhm.
We are negative sectors like materials, utilities. So these are sectors which we think have a challenge going forward, and we are a little bit underweight.
Right. Thank you.
Yeah.
Last one or two question if anybody can ask. So, sir, one question I would like to ask.
Sure. Varun, you
Uh,
will tell me.
Since last 1 year, we are seeing lots of volatility in our Indian market and see almost 2 or 3 times W figure in this Sensex graph. So, when you expect this range can be broken by upside or a downside, because the big events are going to happen in India as an election. So, what you are looking forward for this?
See, Varunji, actually, as I said, the markets are trading at a little bit premium, something like 10% premium to their current fair values. And according to us, the best way and the most investor friendly way in which markets can correct is by not going anywhere. So that is what we call as time correction. The underlying earnings core fair value keeps going up. Markets don't go anywhere and the valuations get corrected. Yeah. So that is how I think the entire valuation correction happens. Um, uh, but at this point of time, we think there is a challenge in terms of valuation to some extent. Macros are challenging to some extent. So our best bet is that the markets stay in a narrow range and time correct, because a nasty correction is not in very good interest for any part of the market. Having said that, higher interest rates are clearly a very important headwind. It impacts the currency markets, the bond markets, the equity markets, and it will also impact the economy. Till date, it has not impacted anything materially. I'll give you a very simple example. Because of interest rates going up, almost 200 bips, which is 33% increase in interest rates over the last 1.5 years. EMIs have gone up for people, right? You would have, and there was a real estate boom in the last 2 year period. So most people took advantage of that 6%, 6.5% interest rate and went ahead and bought a home. Someone who wanted 2 bedroom home, they went for 3 BHK home and so on and so forth. So people have invested a lot in assets in the last 2-3 years, and now interest rates are going up. You can't go out and sell your assets. What you will do is 2 things. First, you will increase the time period for payment, but beyond a point that is not possible. So EMIs will go up. When EMIs go up, you will reduce your other expenditure. This happened in the early part of 2000 and 2003 or 4, if I remember correctly. People reduce their spending. That can result in some slowdown, and such similar sort of a slowdown can happen in various parts of the economy, various sectors. So I would not hazard a guess at this point of time. Suffice it to say, don't overextend yourself. Markets are not cheap. There is a potential for correction, but if you definitely have a 5 year view, hang on in the markets. They will deliver you a much better return than most other asset classes. If you have a shorter time horizon, it's better to be in liquid fixed income rather than anything else.
Thank you so much, sir. With your great experience of 20 years, large number of years, so you shared lots of things, and it's really great value and great inputs in our business and views. So thanks so much. And this is a small vote of thanks for you.
Oh, thank you. Thank you very much.
Thank you so much, sir. Thanks a lot.
Okay, bye-bye.
Thank you so much.
Thanks, Varunji. Thanks for moderating.
My pleasure, sir. My pleasure.